This episode of Startup Project is brought to you by Bear.tax. Bear.tax compiles all your crypto transactions and makes it easy for you to file your taxes. Check out Bear.tax, that is BEAR.tax, Bear.tax. Hey Harvey, welcome to the show.
Hey Nataraj, thanks for having me here.
So I think a good place to start our conversation, I want to talk about RUV Alliance and the things that you're doing up with it. But before that, can you give a quick overview of what your career has been till now?
Absolutely. I started my career in fintech. I started my career at a company called Adapar back in 2011. So when I joined, it was around Series A. They had right around then closed their Series A, I believe. And what they did was build software for wealth managers and family offices. So if you were managing a large pool of other people's money or your own money, you essentially have a lot of different workflows there where you tend to have your assets at different banks, brokers, custodians, and you tend to need market data to value those things. So it's a huge data aggregation problem, which is what my focus was. And then you have to do enrichment and analytics and reporting and all the other workflows. So I was there about mid 2011 to early 2013, I believe, and worked mostly on the financial data aggregation side. And from there, I left to start my own startup in the core banking technology space. So where our vision was at the time was to build a brand new core banking platform. We had a couple different other entryways into that grand vision, but it was that all these banks that are running on 50-year-old systems with very extremely the most legacy of legacy vendors you can imagine. We wanted to build something new that would enable banking to be radically more efficient and improve financial access for everyone. As you can imagine, this is an insanely hard segment to sell into, a lot of career risk on the buying side. So while we did actually find a few banks to partner with who were very open to working with us and building really cool things, we didn't really see a way to scale it in a meaningful way that would not really turn us into mostly a professional services firm. So I left that startup around late 2014. From there, I joined Coinbase on the institutional biz dev side. So my mandate was essentially make the transactions, make the amount of people buying Bitcoin go up, and ideally institutions who have large pockets. And so worked on everything from merchant payments to marketplace payouts to family offices, trading platforms, and eventually what it came down to was launching a Bitcoin ETF. And sort of towards the end of my tenure at Coinbase, or towards the later part of my tenure, I realized that launching a Bitcoin ETF was going to be a 5 to 6 year long process at minimum. And I think, now that we are 5 to 6 years later from 2015, and the fact that it still hasn't launched, it's evidence of that. So I realized that I didn't want to be in a role that had a lot of like legal and market risk. So from there, I joined Plaid right around the Series A, and on the go-to-market side. So helped a lot of the sales processes, playbooks, tools, go-to-market strategies, and things like that. Worked with a really great team of people. And I was there until about early 2017. From there, I left and decided I've always had this itch to do to be an engineer. So I decided to like give that my full-time focus. And so left, did a coding boot camp, did the engineering side, briefly took on some roles, but then realized that, at the end of the day, W-2 employment was just no longer for me. So I had also been doing a bunch of angel investing especially it started while I was at Plaid. And since then, I'd been sort of just thinking about how do we make founders richer? How do we make startup employees richer? And essentially help improve this ecosystem and make sure that more of the people who are doing the work on the ground, the selling, the making, the founding, are capturing more of the upside. And so that led me down an interesting direction, which eventually led to the RUV Alliance.
So that's a good way to, good segue for RUV Alliance. But I want to step back, and it looks like in terms of your career steps, you always joined a Series A startup, or a startup or a Series A startup. Was that your perspective when you're making that decision?
I'd never thought about it when I was making the decisions initially in terms of stage, but you're right. That is absolutely a pattern. It tends to be in the Series A. Like I think Coinbase was maybe Series B or C when I joined, but it was still extremely early at that time. And I love roles. I love companies where there's a lot of open space. Like I'm one of those people, I'm very good at writing playbooks and checklists. I am not so good at executing playbooks and checklists other people have written.
So let's talk about RUV Alliance. So you are angel investing, and how did RUV Alliance come about? Because RUVs, for those who are listening and don't know about it, are roll-up vehicles that AngelList created. and these were primarily to help startup founders, right, to raise money from their friends and family. But you've taken it to another extreme level, I felt, after being part of RUV Alliance for a while. So talk to me about that journey. Like when you figured out you want to do something in investing space, did you evaluate other options before actually looking at RUVs?
Yeah, absolutely. Creating the RUV Alliance was sort of my choice of last resort. I had explored lots of other options, and how the alliance actually came together is a true like startup. It started with a throwaway tweet, and then it exploded into this 1,300 member community. But I'm happy to take you through sort of the details of how this began. So I actually made my first angel investment when I was at Plaid. How it started, and really I feel like the advice that's given to founders in terms of build something to solve your own problem is also actually really good advice for investors. And so to give you an example of that, when I was at Plaid, one of the biggest issues we had was how do we allocate our time efficiently? Because as everyone knows, hiring in startups is extremely hard, and so we had very few people to do what was frankly like probably 10 times as many people's jobs, which is, that's the case at any rapidly growing startup. And so I realized that the limiting factor for us was not money, but time. And so I was thinking, how do we figure out how much a deal costs us in terms of time? So I leaned into that, and I realized that at that time, Salesforce and all these tools would show you the outcome metrics of like how many deals you close, how much revenue you generated, but it wouldn't really show you how much time that deal costs, because that's just generally not how large companies think of things. So I tried to actually start building my own tool to track my time as a salesperson, like how many minutes per meeting, how many emails, things like that. Realized that this was actually a gigantic problem, and it was not something I was going to solve while also working 80 hours a week at a Series A startup. So I was lamenting about this issue at lunch one day, and one of my colleagues mentioned that he knew somebody who was working on this problem. So he connected me with that founder. The tool was exactly what I had in mind and what we needed. We started deploying it, and it was the best example, analogy is like it was like being the only party in World War II to have radar. Like you just could do things that just looked like magic, and we were able to operate at a speed and velocity that was unthinkable to me prior. So I insisted on investing. I met the team. I was just like, I have to be able to invest in the company, and that was actually my first angel investment, and it turned into a unicorn in less than a few years. And so I sort of kept investing down that flow.
Which company is this?
This is People AI.
Oh, People AI. I'm an investor in People AI as well.
Oh, phenomenal. Small world. Great choice, by the way.
So how did that lead to RUV Alliance?
Yeah, so I continued angel investing, just directly, and then so what I realized was it was very frustrating to angel invest. I mean, first you have to reach out to the founder, and you have to build a relationship, and then you have to exchange safe docs, and then there's this whole like song and dance. And at the end of the day, like I'm a bit of an introvert, which is ironic considering I've always been in like biz dev and go-to-market roles, but like I never want to take a meeting that I don't absolutely have to take. So I started at that time thinking, you know what, I might just be okay with paying carry on AngelList because it's like an e-commerce like experience. Like I can see a deal, I can click invest, and I can go about my day. Because all I want to do is pick securities that go up 100x. That's like if they do other things, that's cool, and we help the world, that's great. But at the end of the day, I'm in this business to make money. So I started doing that, and then I also realized, a lot of these companies that I'm like having to pay carry for, I'm seeing them anyway. Like I'm like running into them as part of my daily life, friends, founders, things like that. So that was happening. And then there's another thread, which was so while I was doing that, and I would still have to go after direct deals, I kept getting muscled out of deals because I'm a nobody. At that time, I mean, even now I'm still a nobody, but I just was like a person writing 5, 10K checks, the occasional 100 into like, but I didn't have a brand name. I didn't really want to have a brand name. I didn't really want to raise a fund, etc. But I just wanted to get into the deals I want to get into. So this started bothering me, is I started getting muscled out of deals. So then a third thing happened, which is I got the opportunity to co-lead an SPV into a later stage company. It can't share the name, I think, but I got a chance to co-lead this SPV. It was a great experience with the team we worked with. But what ended up happening was we were so successful in how much we raised that we actually we were so successful in how much we raised, and simultaneously a lot of other folks were interested in that same deal. And for logistical reasons, et cetera, we got muscled out of it. So we actually had to start returning money to LPs. So that kind of also set me on a way, which is like, I'm one of those people, like, I cannot stand to not have the most leverage in the room. So that started bugging me. Like, I'm just like, I got to have control over things. So I started thinking, and at the same, and so along with that thread, I was talking with a lot of friends who were joining startups and helping them negotiate their equity. And so in some cases, helping them get like 7 figures more, you know, like I'm sure in some cases, and now it's started to like 8 figures more in equity upside. But we always ran into this issue where like they couldn't really get more beyond a certain point because they were negotiating for options and common shares. And so there's these 4 threads were running simultaneously. These handful of threads were running simultaneously, and they kept bugging me. And so what I started before the RUV Alliance, which is what led to the RUV Alliance, is this concept called employee-led SPVs. So what I realized was, what do founders raise money for? They raise money to hire people. What's the thing that sucks when you hire people is when they leave. So what if you could make it easier to hire people, and you could keep employees from leaving, and you could boost an employees' equity upside? So how would you do that? So what I realized was, what if I go to employees at startups, existing or future, and I say, hey, together, let's go negotiate for an allocation in the startup you work at, and I'll help you fill it, and on the fundraising side, and we'll split the carry 50-50. So that was the initial thing I was working on for pretty much mid 2019 to early 2021. If I'll stop there if there's any questions or thoughts.
So initially your idea was to do a regular SPV, but have a carry share, and basically convincing the employees to invest, and partly, and then expanding through your network to fill the rest of the SPV's commitment. So that was your initial strategy, right?
Exactly. And so we ran it a few times, and it worked phenomenally. I mean, the numbers are unbelievable. Like, I think we did a 4x DPI, a 4x distribution to paid in capital within a year and a half, which is unthinkable. I mean, so, but the issue there was a couple things. One, it runs into all the same issues companies who are doing secondaries have, where you have to find an employee first, you have to find an existing person, then you have to convince the CEO, and then you have to like source capital. So one was just finding the employees who were willing to do this was very hard. And I tried everything. I tried cold emailing like every employee at like every Series A and B startup. I mean, there are a lot of people who work at startups who have my email in their inbox right now, and so I was able to find a few folks who were willing to do this, and we then convincing the CEOs was actually pretty easy. Like once they understood what the mechanics were, they were completely for this. And then the third part was raising the capital. Now this is where I got surprised. I thought this would be really hard. So the first employee who did this, that person, I thought, okay, we'll raise like, mid 6 figures, et cetera. Like it'll probably be, like take a week and go try with your own network. If you only get like 10% of the way, that's fine. And I'll take care of the rest. Like I'll backstop it. Within 48 hours, completely massively oversubscribed, because, I think most LPs realize what an obscenely good deal this is. It's like, oh, I'm paying carry, but the person I'm paying carry to is basically working on the company full time, making my investment go up, and they have common shares. It's like the company has paid for the GP commit. It just, the incentive alignment is so crazy. So, and every employee that I worked with started having that, level of success. Like it really took like no work, like they within 24 hours.
Were these part of an existing fundraising round, or is it just a middle of a nowhere equity round for the company?
So both. So in the case of an existing fundraising round, we would just say, give us the same terms you're already doing, which was easy. What was really surprising to me was when we started doing off-cycle raises, where essentially we would approach the company and say, can you give us an uncapped safe at 20% discount? And, for them, that's like, why not? That's basically raising their next round. It's like a dollar for dollar reduction almost with that slight discount. So they would just say, yeah, sure. So they would issue us the safe. And then, I thought this would be really hard to raise for, and employees within 24 hours were just smashing like, $500,000 raises. And so 2 things occurred to me. One, once I've shown an employee how to do this, there's no real reason for them to keep me on for the next deal. So like all this like customer acquisition cost I spend to acquire this employee is gone, because, and I'm not saying the employees did this, but like it's what I would do, and that's what and to me, like the incentives are everything. I don't believe in ideals. I just look at incentives. So I'm like, the incentive is for them to cut me out. And then 2, we started talking to CEOs, and they started asking this very interesting question, which is, how could I do this for all my employees? And that started leading down a very interesting thread, which I realized also implied that once we taught CEO how to do this, why would they need me anymore? And so that was happening. And then the third thing that happened was I started talking to some of my portfolio company CEOs and a couple other people. And I started noticing this very interesting trend that people were doing, which is they didn't want to deal with 50 angels. They wanted to bring in all these operators as investors, but they didn't want to deal with that. So they would like set up their own SPV and then they would just waive the carry and then, pass through the fees. And the moment I started seeing that and I reasoned through what that entailed, I was like, well, this whole business I'm doing is over and will never come back. But this whole new thing is the future. And like in the reason why, and I'm happy to go into this in a second, is that there's a lot of, it's tempting to see RUVs, these roll-up vehicles, as an administrative tool, but that's actually not what they are. They're a strategic tool. And so that's kind of where like my head exploded.
And there's an interesting parallel between RUVs and now suddenly popular term called DAOs, right? Because the mechanics are pretty similar. Like whenever people talk about DAO, my mind goes to two things. One is RUVs, and the other one is equity crowdfunding, right? If you make it so easy to raise capital, like which is RUV essentially, it almost mimics the dynamics of a DAO, right? Because in RUV case, you almost are taking pre-commitments for the startups that you're interested in, right? In your Discord server, you're taking pre-commitments for a startup, which I don't know if you do that after initiation or before initiation, and I'm assuming it's before you're initiating any call with the founder or not. But it almost similar to the dynamics of how a DAO generates crowd investment into a company. You're almost generating distribution first and then creating a company. And there's also the effect of democratization of access, and there's ease of process that is there. I don't think DAOs, in a sense, like are aiming to be all this, but there are some instruments which are already these. And we can go into DAOs, in a bit. But so once you decided, RUVs are the next big thing. How do you see this, different from, if you do an SPV, right, you're getting an additional carry, right? That's your advantage because you're doing all this work. You as Harvey is getting extra 10% or 20% carry on whatever SPV that you're closing. Then how did you shift your just in terms, because you talked about leverage? How did that leverage change for you when you started, doing deals through RUVs?
It's a great question, and there's a lot of interesting moving pieces there. So so it's a couple things. One is with RUVs, we operate a little differently than most investor communities. And this is something in that we do not work for the founders. The founders are not our customers. It seems like it in every investor community, et cetera, will say, oh, we put the founders first. We absolutely do not. Like that is not our goal. Our goal is to make investors rich. And so that actually leads to some very interesting things, which is one, so there are a lot of investor communities out there where you can submit a deal, et cetera, and like it's very supply push. Like the founder is pushing the deal to investors. We allow for that functionality, but frankly, it's not the highest priority. That's not really where our value add is. It's kind of like more of it helps us in case we get positively surprised, which definitely happens. Like sometimes companies come in and I'm like, wow, I would have never seen this company, and the community loves it. But where we specialize is in demand pull. So what that means is we aggregate commits, as you said, and then we actually approach the founders, and which is actually the reverse of how RUVs are traditionally, doctrinally designed to be used. So if you look at the RUV providers today or anyone who's equivalent, they pitch this as sort of an administrative tool, which is, okay, hey, you're a founder, you've got yourself a lead, you got your terms, you got like 50 angels you want to bring in, you don't want to deal with paperwork, that's fine. So you can do that, and that is a completely valid way to use RUVs. But there's a strategic change. What RUVs actually are is a strategic change in the landscape. It's kind of like having a car in World War I and then suddenly realizing, wait a minute, what if I put armor on the car, a gun on the car, and then I put tracks on the car? And all of a sudden you've changed the entire nature of warfare. You've taken three things that already exist and you've just combined them in a unique way. So what we realized with RUVs is that, one, what if you reverse the process? Instead of the founder creating the RUV and then reaching out to investors, what if the investors effectively create the RUV and then reach out to the founder? And all of a sudden you change everything, because one, those investors are actually willing to pay a higher valuation because the cost is the same to them versus going through a syndicate. So, they're willing to pay basically up to a certain point but it's higher than whatever an SPV lead or a fund lead would pay because they don't have that 20% hurdle or that 2 in 20 hurdle to go over. 2, we proxy our voting rights to the founder, which is, I mean, as a founder, like that's like the dream, which is you can raise more money and never lose control of your company. Like who would not take that? And 3, RUVs are actually more liquid than company stock. So RUV interests. And so you can actually sell an RUV interest. I mean, the mechanics of this are still being worked out as we speak, but let's just say I've done something very similar to this and it was very smooth. And so it's much easier to sell RUV interest than it is to actually sell shares in an individual company. So you get a liquidity improvement, you get a corporate governance improvement relative to the founder, and you get a valuation improvement. And so we realized the thing that's blocking founders is that like if you take an SPV, here's a better way to think about it. If you take an SPV lead and you unbundle what that SPV lead is actually doing. So what are they doing? 1, they're sourcing a deal. 2, they are spinning up a vehicle. 3, they have a mailing list of investors that they send the deal out to. So now that RUVs, founders can create their own RUV, great. You know, they've set up their own vehicle. Sourcing the deal, I mean, companies are pretty easy to find these days. I mean, in terms of the ones who are interesting. And then it's the investor network. And so we realized, what if we provide the investor network basically as a service effectively? So you, the founder, can just submit your deal. And, you know, next thing you know, you're in front of 1,300 plus accredited investors, all of whom are like, you know, top tier operating experience. So that's sort of like how we've been thinking about it strategically. And we realized that this actually changes the entire dynamics of the fundraising landscape.
What has been the response from the founders? And there's an additional factor when RUV Alliance came up, right? It came up in pandemic when fundraising essentially suddenly became global. And I see Indian companies raising from US investors and vice versa. Like it's now every investment is up for grabs, right? Because any investor sitting anywhere can do, you know, due diligence. So it's no longer, you know, differentiated in terms of geography or thesis, or I mean, maybe thesis, but that's your own mental model for it. But every investment in every country, in every sector is basically up for grabs. So you also came up at a time where this is happening simultaneously, which made sort of founders probably more receptive to the idea as well, right?
Absolutely. So the macro factors you described, 100%. One is the comfort with like taking capital from people you've never met, which is, or people you've never even had a Zoom call with or a phone call with. For example, one of our first deals was into an Indian company, and we raised over 300,000 for that company within 48 hours from 60 LPs from all over the world. Not a single meeting, phone call, or Zoom. I mean, unheard of like 5 years ago to do something like this. And so, yeah, we're standing on a huge stack of like giants of people who built this amazing process. And, you know, we've had companies from Pakistan, from Mexico, from all over. And yeah, the democratization is, it was not initially what I thought this would become, but I'm very happy to see that that's the direction it's gone.
Your deal flow on RUV Alliance is almost extreme, I would say. Like the number of deals I see as part of RUV Alliance is like really high. How are you able to generate such, you know, large amount of deal flow? Like, is this mostly you reaching out, or is this, you know, members of RUV Alliance reaching out? What is the process, behind the scenes process that is happening, which is generating such incredible deal flow, both in quality and quantity?
It's a great question. It's mostly the strength of the community, really. I would say 99% of the deals that come in, all that like happens is like, I find out about the deal at the same time everybody else does, in that I get the email notification, I hit submit, and it gets sent out to the group. And so it's mostly the community talking about this. This sort of goes back to the initial question you had about how do founders see this. And so to go into that, is that founders, the initial reaction of every founder is disbelief. 100%. 99% of my burden when speaking to founders is just like, it's just explaining to them how they will not get screwed by working with us. It sounds crazy, but like the deal was too good, frankly. And like, frankly, if we made the deal a little worse, it might actually make it ironically easier to sell to founders. So one is that. And then, so a lot of founders, once they do a deal through us, they refer everyone they know to us. And that's like why we just published our 100th deal actually yesterday. And I calculated we were founded on July 2nd of 2021. So that means on average, we have been publishing a deal every 48 hours to our members.
Have you gotten any feedback from people who are already running, you know, syndicates and other SPVs and have a model with higher leverage, right? And we have now large syndicates with 3,000, 5,000 accredited investors, and you are in a sort of ways competing with them for deal flow. What was the dynamic, with syndicate leads or other micro funds or solo GPs? How was that dynamic been?
It's been very collaborative and collegial. It's initially I had framed a lot of our framing as like, yeah, we're against, the carry industrial complex and all that. But really fundamentally, it's a bit more nuanced than that. And so we actually work very closely with a lot of SPV and fund leads. And so we've had situations where we published a deal and then, a GP of a fund will reach out to that founder saying, oh, we found you on RUV Alliance, and then they'll write a large check into them, which is great. We love that. Anything that makes founders richer faster, I'm all about that. And so the other thing we do is if you're an SPV lead or if you're leading an SPV and you want, we see this a lot with like emerging managers and emerging SPV leads. The biggest challenge is getting yourself in front of an LP network. That's like the whole secret behind all of this. So what we do is that, well, that thing that's really hard and expensive and terrible to do, we're just going to make it free. And so if you as an SPV lead, if you are willing to waive the carry on your deal, you can actually submit your deal to us. We will share it out just like any other deal. And then what's really great is any of the LPs that come in, you now have direct access to those LPs. So it's basically like, instead of you having to do networking and coffee meetings and things like that, you can just audition by actually doing the work. And so you can, like, if you put out good deals, people will follow you. And that actually kind of goes into another point in terms of like how we differentiate from a lot of the fund managers and syndicate leads out there, which I'm happy to get into.
Yeah, how do you differentiate RUV from other fund managers?
Yeah, so here's a great way to think about this. If you want to buy a share of Tesla stock, there's a couple ways you can do this. One, you can just buy it for free on Robinhood. You pay no commission, carry, management fees to do that. You can invest in a mutual fund that owns Tesla, and you're going to pay a little bit of load or fee for that. You can invest in an ETF that owns Tesla. You're going to pay some asset management fee there. You can invest in a hedge fund that owns Tesla. You're going to pay 2 and 20. You got all these. You can invest in a wealth manager. They're going to charge 140 basis points, and maybe you'll be investing in Tesla. So there's all these different ways that you can get exposed to Tesla based on what level of advisory you're looking for. Like you can go everything from like me as a direct stock picker to like, I don't ever want to think about this and I want to hire a manager to deal with it. And then I think that's totally legitimate. I think that's 100% how the market should work. You shouldn't have to, like, you should pay for more levels of advisory work. Now, what I am 100% against is what I call access-based fees. So if you as an investor know you want to invest in something and you can't do it because access is restricted for some arbitrary reason, or it requires, like personal relationship, whatever, to me, this is the enemy. So I call this access-based carry. So I love advisory-based carry. If you're a top tier fund and you make, those types of picks and people are hiring you for your advisory, great. Pay as much. I think those managers actually undercompensated. 2 and 20 is a bargain for the best managers. Like they should charge more. But there's like folks out there who are basically arbitrarily keeping these deals because you can't like invest in them unless you pay a huge amount of fees or things like that. When it's like, I don't need this person's advisory work. I just want access to this deal. So for example, if you want to invest in SpaceX, that's a whole like different thing because you're going to be investing in SPVs that pay like 4 levels of carry when like, I don't need to be convinced in any way, shape or form that SpaceX is a great investment. Like I don't think most people on planet Earth don't need to be convinced of that. They just want to be able to hit it on a buy button. So our philosophy is freedom of trade for all the same reasons as freedom of speech.
I mean, there are a lot of interesting points in terms of access that you brought there, because arbitrarily most private investments are restricted by accreditation rules, which it shouldn't be, because anyone can go to casino and lose all their money. I mean, there are penny stocks listed on stock exchanges, which go up and down by 90% plus in a day. So it's a very arbitrary decision to restrict private investing through accreditation rules. So I think AngelList sort of played and went and did the Jobs Act, which led to equity crowdfunding, and then things started changing. And even with rolling funds now, you can actually publicize your private deals, but there's still that restriction which limits access to a lot of people, because how is a person with 190K salary is different from a person who's making 210. Suddenly it's not intelligent by leaps and bounds to understand private equity to invest in it. Right. So I think that's at the core, which also prevents access to deals and sort of perpetuates this whole system. Another interesting question that I thought of asking you is about, how did AngelList react to this? Because I know there's some AngelList team members also in RUV Alliance, and they probably wouldn't have imagined someone like RUV Alliance coming up and doing this sort of a thing.
Yeah, that's a great question. So one, I talk with them fairly often, and I'm a huge fan of everything they've done in the space to accelerate things on the RUV front. And the fact that they're charging nothing for it except for blue sky fees, which are regulatorily imposed, is mind-boggling. I mean, this is a mind-shattering thing that has been achieved. So how they react to it actually goes back to how this actually started. So what I noticed was in January is when I stopped working on it. January 2021 is when I stopped working on employee-led SPVs. So for 2-3 months, I was kind of just like in the void trying to figure out what to do next. And then I saw the announcement, I believe in March, is when AngelList launched the RUV product. And I realized, wow, RUVs are like safes. Like this is going to be the next thing. Like this is the default of how founders should fundraise. So I started looking for RUV deals, and I realized that there's actually there's no way to find them. So for example, there's no equivalent of a syndicate you can subscribe to or a mailing list you can subscribe to find these. So one day I was complaining about this on Twitter back in July of last year, and another founder had DM'd me. So a founder had DM'd me and said, hey, wouldn't it be cool if there was like an Airtable or something that like we could just list all the deals that we see and we could just like crowdsource these? And I was like, yeah, that would be cool. And then I was like, yeah, I've never like used Discord. Maybe cool to have like a chat room full of that, because like I'm in a couple other investor Slack groups. And so I casually put up a tweet. I was like, oh, I'm starting a Discord to like track RUV deals and, for founders and investors. So if you want to join, here it is. Thinking like 5 people would join. And it was, that was my mistake. And then, it exploded. And then every day we were getting like, like 20, 50 investors, like people like, just, from all over this, like all over the Silicon Valley, all over the world, like tier 1 operators across every dimension. And then it dawned on me, wow, there really is like a need to expose these deals. But there's obviously a lot of concerns. Like if you're the platform itself, like, do you want to be like in the like sense where it's like it looks like you're doing marketing, et cetera? Like we're a completely independent entity. Like we have raised no money. We actually run on donations, which is like shocking because we're probably the only like investor syndicate that runs on donations, which means that we have total freedom of access. And we have 1,400 people, we have 1,300 people who are eyes and ears everywhere looking for deals. So in terms of the collaboration with them, it's been great. I mean, we are constantly sending feedback back and forth. We're constantly, introducing founders to the concept of RUVs. So yeah, so far I loved working with them. And I think we're actually going to see a space where more fund admins start offering an RUV type product.
I mean, you're doing their go-to-market strategy and customer acquisition in a way that they have not imagined, right? And I'm sort of surprised that the RUV Alliance runs on donations. I didn't know that. So that sort of is a good segue to my next question is, do you have plans to like, I'm sure you've seen Stonks.com, right? They're essentially in a similar model, but they're essentially changing a version of what RUV Alliance is, but I would say, I'm not sure if they're actually charging carry or not. And Stonks.com is pretty viral and a lot of people use it, to sort of look at startups and invest. Do you have, and they're also, actually creating a company around it and raising funds to, more streamline it and do, all fun stuff around it. What are your plans with RUV Alliance next?
Yeah, it's a great question. So in terms of Stonks, I love Stonks. Big fan of the team there. We, are always like sending deals to them if we can. And so I love what they're doing. And I think for the idea of like synchronous, like demo day type fundraising, it's awesome. Like I personally am just a very like async type person. Like I just will avoid any meeting I possibly can. So it's like, it's not sort of the framework I approach with deals. Like for me, it's like, oh, when I hear about a company, I, then we'll be like, all right, great, I'm gonna go read 50 books on the subject and then I'll make my decision. And so, I think it's a phenomenal platform. What they're doing is massively democratizing access and, more power to them. So in terms of the business model, like it's something I've been thinking a lot about. One thing that I want, so one, in terms of how we run on donations, this I think actually shocks a lot of people. We have a public, all our finances are public. So every dollar I spend on tools for this, assistance, whatever it might be, you can actually see all of it on our opencollective.com/RUV-Alliance, I think is the URL. So it's all there, like our invoices, everything, every person who's donated, how much they've donated. And for me, it's just, I think the most important thing is incentive design, always. And so there's a few things I want to solve for what we're doing. For example, I really want us to get to the point where every growth stage deal in the world, you can see it on RUV Alliance, you can invest for free. I think we're actually very close to that. We are sort of building that playbook now. And once we're able to do that, then I think it'll make sense to figure out like how we can charge for this in a more effective way. So one thing I'm pretty much uniformly against is charging any sort of commission type structure, charging on a carry like type structure. Because to me, like there should always be a free path. Like if you want to be the self-directed investor, like you should not have to pay carry if you already know what you want to do. Like I've also thought about starting my own fund. I haven't committed to anything on that front, but it's like a lot of people have said, "Hey, I just invest in what you invest?" I'm like, yeah, there's a there's a way that that's traditionally done. So if people just want to buy advisory services, that's a conversation I'm willing to have with them. But yeah, it's kind of open-ended. I mean, the other thing we've thought about doing is actually doing lending. So we'd actually, if you want to do buy now, pay later for your RUV investments, we'll actually lend you the money to do that. So I thought that's like a potential interesting direction we might go. But yeah, it's still kind of open-ended on the business model front. But I mean, at the end of the day, this thing costs less than $100 a month to run. I mean, not counting my time, but I mean, in terms of tools, it's less than $100.
Yeah, I mean, I could easily, think of a place where people would pay, a monthly subscription to just access RUV and to see all these and with no carry, right? That's a promising bargain for anyone who's a seriously angel investing and has a certain set of investments that they want to do on a per year basis. I think it makes sense for them to pay, $100 or on a year, or I don't know how we have to think about the exact number that makes sense, both as a company and for the investor. But I could see easily, a serious angel investor paying for such access, because it reduces so much hassle. It's almost like a better version of AngelList. Like if you add a UI on top of what you're doing with Discord, I think it would almost be a version or a layer on top of AngelList, which is much more simpler and better aligned in terms of incentives. But the next topic I want to talk to you about is about what you're doing with DAOs, and what you're trying to do with DAOs in general, and the current project that you're also started in real estate, and how are you mixing DAOs with real estate?
Absolutely. Yeah. So that came up in a really interesting way. And what's really funny about that is I thought there would be no overlap between what we're doing for RUV Alliance. It turns out there's actually a ton of overlap, which has been very funny. So at a high level, what we're trying to do is for this DAO. So it's called Miami100 DAO, Miami100DAO.com. And what this DAO effectively is we've set ourselves like a really big, hairy, audacious goal. So that goal is build 100,000 rental, brand new multifamily rental units in the greater Miami, South Florida area every year. Now, that is crazy, and it's crazy because one, I think it's only between 200 to 300,000 units of this type have been built in the entire United States, of population 300 plus million people in the last year. And so we're talking about basically building more in Miami than has been built like that's ever been conceived. So this is like the Apollo project for housing. Now, one of the things that's unique about the way we want to do it is all private funding, no like fancy tax credit financing, EB5, any of that stuff. That stuff's all great, but like we want to create this as like make this as repeatable as possible. So fundamentally, what we want to do is create Y Combinator for multifamily rental developers. And so that actually has like a lot of moving pieces to it, because kind of like 2005, 2004, et cetera, before like Y Combinator existed, there was no real good playbook for SaaS founders. There was no good real like source for like the earliest, riskiest form of equity. And I think that kind of gap now exists in the rental space for building apartment units, because and the proof is that there's a housing shortage in every single city in the United States in terms of like housing prices just continuously skyrocketing for rentals.
And how does the DAO play into this?
Yeah, so there's a few things that we're doing. So step one is actually building a playbook, which is if you have no real estate experience, but you're an ambitious go-getter type person, and we want to build a playbook. So we're building a playbook such that you can start reading it from the top, executing it. And by the end of that playbook, you will have a fully stabilized, cash flowing, 1,000-unit, 1,000-foot tall, like skyscraper sitting somewhere in Miami that you own as like as the general partner. But which would be like $1 billion asset basically. So essentially, like that's like the playbook, is how do you go from $0 worth of real estate to $1 billion worth of real estate as quickly as possible? And what we realize is the hardest form of equity to raise for this is the earliest form of equity, which is like you, the developer, need to pay for like, an architect, you need to pay for like a financial model or things like that. So you can actually like put a plan together, approach a landowner, buy an option on the land, and then like get approval from the city before you close on that land. So that equity is like the hardest, riskiest. I mean, it's like pre-seed, seed angel type equity. So we are thinking is like the DAO would effectively seed those GPs with like equity.
Does it actually require a DAO, or can't you do it with any other traditional instrument?
You probably can. I think I was just excited about DAOs when I created the name. And so we thought, oh, let's go with that. And because I was pretty inspired by what the Constitution DAO folks were doing. And so I was just like, oh, like if we could build something like this, but for like actually delivering housing units like in the US. And so in the DAO at that point can actually act like it's basically not like a pure investment entity, but something like that, like a governance and investment entity. But yeah, I think it could actually be, most likely what will happen is we'll use traditional structures up until the absolute breaking point, and then we'll use crypto structures where we actually need them.
So in essence, it is still possible to get DAO-like dynamics without using DAO, right?
Yes, if you're using the absolute most cutting edge tools today with certain limitations, you can get there. So for example, you had mentioned earlier equity crowdfunding. So equity crowdfunding before March 15, 2021 was a very different animal than what it is today. And the reason is, if I remember right, the law changed such that you can use SPVs. Whereas before that, you actually would have like 10,000 people on your cap table. Republic and WeFunder itself have done things to streamline that. So they have a special type of crowd safe where it doesn't convert until exit. So it's not like you have to deal with like 1,000 signatures at every conversion point. Yeah. But it still kind of was a mess before the SPV side of things. But now that you can do it via an SPV, what is really the functional difference between an RUV that it only holds accredited investors and buys into a safe at a company, and a regulation crowdfunding raise that raises into an SPV that buys the same instrument? Not really much of a difference, frankly, besides the regulatory burden.
Yeah, I think there's also a restriction in terms of how much amount of capital that you can raise and from how many people should be on the SPV and things like that. But fundamentally, in terms of incentives, I think there's not much difference. That's great. And you seem to me as a person, and this is obviously a first interaction, but someone who reads a lot. Am I right?
Yeah, that's a fair point. I try to get through at least like a few books a week.
Yeah. So what are some of the interesting books that you have read recently and that you would want to recommend?
Oh, let's see. One that I read recently, I'm actually rereading it. It's called Atomic Awakening. And what it is like a history of nuclear power and nuclear engineering, basically from the discovery of the atom to the modern day. And so it's really interesting because up to the first 50% of it is like up to the Manhattan Project, and the other 50% is to the modern era. And it's actually mind shattering, like what people were attempting and what's actually possible with nuclear energy. It's just that like it is so scary to people in the world today. Oh, there's an excellent one. I forget the exact name of it, but it's very easy to find. It's a biography of George Marshall. So George Marshall was chief of staff of the U.S. Army. So he was the head of the U.S. Army during the run-up and the execution of World War II. And also he was Secretary of State, I believe, afterward, and was a big part of like negotiating things between China and Taiwan and things like that. And so very fascinating to read about this person who was the actual like basically the head of the Allied forces, and actually coordinating, and then how he helped coordinate across multiple different stakeholders across different countries and different groups, like how to actually execute this massive operation that fundamentally changed the course of like civilization. So I think that's a very fascinating read that I recently went through.
So I want to ask one last question because you touched upon this word leverage, which I like a lot, and I use it a lot in my vocabulary as well. Where do you think the highest leverage today is? Because I personally believe that we're in a hyper leverage economy. You can leverage code, capital, media, anything, and an individual can leverage, has infinite amount of leverage at their disposal because of internet, and everyone is connected and on a network. And where do you see personally where the biggest leverage lies?
It's 100% content, because it's the only thing you don't need any specialized training to create beyond a certain point. I mean, anyone can sit down and write into a Substack or things like that, or tweet. And I think fundamentally people just don't create enough content. I think the future of even being a founder and a venture-backed founder is to be an educator / entertainer first. So for example, if you're wanting to build a hard tech company, like I would like to think of like, somebody like Elon Musk was starting today, the way I would like start it would be, start recording, start teaching people what this is, like start teaching people what rocket science is on YouTube videos and things like that. And you essentially then establish yourself as an expert. You build this huge audience. Then you start introducing community aspects to it. And then as you have this audience, this community, this content machine, and you're just chasing like what you find interesting and where you think the problems are, and you're interviewing people in the space, then you see where the problems are. And then that's where you can either A, be an investor of sorts, like a capital allocator to people solving those problems, or be the person solving those problems yourself. And that's like basically the approach we've taken with the RUV Alliance. Like before we actually did the Alliance, I had written a ton about what I was doing with employee-led SPVs. Like I think I still, maybe to this day, am the only person who's published an actual like comparison of SPV providers and how you should think about using them. And so I open sourced everything I did before that. So I had this like 1,000+ people who had been following me because of that, which immediately was able to leverage into RUV Alliance. And then because of that, there's a whole bunch of people who, have followed me into this Miami100 DAO. And it turns out a lot of the companies, like as we're building this playbook for Miami100 DAO, that there's a lot of like steps in the checklist that used to be very manual, but are now being done by Series A and seed stage companies. So now those companies I'm reaching out to, and then they're really excited about what we're doing in Miami100 DAO. And then I'm like, hey, by the way, I run this investor syndicate, and then we're sending them to RUV Alliance. And so like this content turned into community, which is now turning into like capital allocation, which is turning into like, cash flow and all these different things. So yeah, I think the era of leverage is it must start with content. Like everything starts with like, like a written outline of what you want to achieve.
So I'll go back to the question and press you a little bit more. Where do you see your leverage, and how are you seeing your own personal leverage? I get it that we're in a distributed first economy, so building distribution first and going backtrack. So is that the same playbook that you're following? Because with RUV, that's what you did. And sort of created content, and then now you're using that distribution to do Miami100 DAO. And are you following the same playbook of being distribution first?
Absolutely. I think I see no good reason to ever build anything not distribution first. Like having worked at startups, where some were further along on the distribution point than others, quality of life is 100% proportional to how strong your distribution network is. If you have great distribution, everything's easy. And so for me, I find my highest point of leverage is laying out a written plan and publishing it. Because one thing I'm willing to do is I'm willing to look wrong very publicly, very aggressively, more so than the average human being. I relish in it. I love rejection. When people like tweet hateful things about me and replies to my stuff, I retweet them just because like that's how I'm wired, and so I'm willing to take those arrows first and take them very publicly, but like help. And what often happens is like, people reach out and things like that. And then I'm able to help create like a cohesive written plan of like, oh, this is like where we want to go. And generally, once I'm able to put like that kind of plan together, a lot of like people in the community come together, and we were able to fill the operational gaps and the strategic gaps very quickly. So for me, my highest point of leverage is like writing plans and publishing them, and then reaching out to relevant experts.
This has been a great conversation, Harvey, and I think you're doing something, and you are also an intense person that I can clearly say without seeing your face. You're an intense person. I think you understand leverage and distribution very well, and you also understand where the edge is, and you're willing to go there first before anyone else is, and that's where you generate most returns. So it's been a fun conversation for me, and hope you had a good conversation. And thanks for being on the podcast.
Absolutely, likewise. Big fan of the podcast, and if I can ever be of any help, please let me know.
Thank you.